Well, thank you, Marty. It's great to see you. Great to see everybody here in the room. Thank you for coming out. We're talking about alpha strategies this morning. Specifically, we're talking about where you can find alpha, right? So what I'm going to do first is just sort of, I think everybody has an intuitive feel for what alpha is, but just to go through a quick definition, it outperforms the benchmark by a significant amount, usually is actively managed, and identifies market inefficiencies that allow for alpha and whose lifespan is limited. So timing can be very important. And to sort of help us talk about this topic this morning, we have a great panel here. Nick Markola is right here to my left. He's the managing partner and CIO of the Markola Group. Sitting next to him is Michael Weinstein. It says adjunct professor of finance and economics, but you'll learn he's a family office, affiliated with family office, plus invests on his own accord. Vidak Radonjic, founder and CEO of the Beryl Consulting Group. My apologies if I didn't say your name correct there.
It's all good. Radonjic. Very exotic anyway.
And Balaj, great to see you. Balaj Singh, Vice President of Meketa. Meketa, as many of you probably know, is a gatekeeper for many pension funds, public and private, and he will be bringing the institutional point of view to all this. So my name is Mark Heil. I've been involved in alternatives since the mid-1990s, which dates me right. Maybe carbon dates me, I'm not sure. In various capacities in marketing, capital raising, fund administration, and helping investors retirement funds to invest in alternative assets. So very, very different angles. I'm currently a managing partner with Pickwick. We are an investment banking firm that provides services to middle market companies as well as funds. We have a couple of clients here. We have Anthony Nula and Nick Sinatra here of the Sinatra Group. They're a real estate group looking down in Florida. So be sure to say hi to them if you have a minute. Disclosure here. This panel is for educational purposes and not to be considered tax, legal, or financial advice. To the extent that one of us offers an opinion, it is our opinion alone. It does not necessarily reflect the organizations we represent. So for the next hour or so, we're going to be talking about alpha strategies, and you're invited to participate. The only thing I'm going to ask is no speeches when you ask your question. Just get to the root of it. We need additional context. We'll ask you for a little more info, okay? With that, I'd like to start having our panelists introduce themselves. I'm going to just start it here with Nick. Why don't you kick us off? We'll just go straight down the line.
Sure. Working? I believe so, yeah. Good morning. Thanks very much for coming here today. My name is Nick Markola. I represent our own family. We invest money for ourselves. In terms of my career, early on, I spent time at large banks, Bank of America and Citigroup, and then for about a decade, I spent time at a multifamily office / private bank when I ran the investments and then made the transition to managing investments for our own family, and kind of a dual approach. On one end, really low risk investments, most in real estate and cash generating strategies. And on the other side, very high octane risk investments and kind of marrying the two together.
Hi, Mike Weinberg. As Mark was kind enough to mention, I'm an adjunct professor at Columbia Business School. I also work with a family office and a Japanese endowment and do some other things as well. And I've been in the investing in alternatives previously as a hedge fund portfolio manager at Soros, the family office, and other various institutional firms for the last for some time. I'll pause there.
Hi, good morning. My name is Vidak Radonjic. I'm founder of the Beryl Consulting Group. We started in 2004 with a mission to find the best of the best hedge fund managers. So up to date, we're still mostly focused on that asset class. However, we also follow private equity, venture capital. We look at credit as well, private credit. And yeah, thank you for having us here, Marty.
Good morning, everyone. Great to see everyone. Thank you again, Marty, for the opportunity to be here. Meketa Investing Group mentioned we're an investment consultant based out of Boston, serving since 1976. First client was the Harvard Management Company. I serve in the private markets department at Meketa. So I cover private markets, private equity, venture capital, growth equity, private credit, and I've been doing the allocator role since the start of my career at Hamilton Lane. Great to be here.
Hold on that mic because I'm going to come to you first.
Okay.
Okay?
Yeah.
Before we dive into talking about alpha strategies, let's talk about the anti-alpha strategies. Where are the blue cells on your heat map?
Blue cells. Interesting. So within private market land, I think an area where clients are trying to diversify is in the private credit sleeve, and we'll have a lengthy discussion about that. I think traditionally a lot of LPs started building out their private credit portfolio with direct lending. It's an easy enough concept to digest for a lot of ICs, which is, trusting mega sponsors, sponsor-backed deals with the senior secured position in the cap table. It's evolved since then. I think going forward, maybe direct lending is not going to be an area of focus for clients going forward, but more so, building on that sleeve with opportunistic credit, specialty finance, special situations, depending on where we find ourselves in the market cycle.
Go, Michael.
Do you want to talk? Do you want to?
Yeah, turn on here. You got keys.
Yeah. Now it's on. Thanks. Do you want to talk about your private credit now or later? Max, or?
Let's
Yeah.
go. You know how I roll up here. We just take it as it comes.
Yeah, because my view on private credit is sort of constantly evolving. I thought I think it was quite interesting earlier this year, but I think lately, so for example, obviously high yield's high yield. I think that's just the spreads are at obviously record low tights. I think that's completely unattractive. And then in terms of private credit, I think it was more interesting earlier this year, but then now with what we're seeing in terms of spreads and spreads coming in and even rates coming down a bit, cov light, picking, all of that, certainly on the larger end, much less attractive than it was. Maybe lower middle market, still relatively interesting because it's less competitive. So those are some of our thoughts on private credit at the moment. I don't know what yours is.
Yeah, no, completely agree. I think we're starting off with the blue cells of anti-alpha. I think the mega cap space is very competed and the spreads there are getting tighter and tighter as more folks enter that space. Your blue chip mega shop, their strategy for AUM growth is private credit these days. So, and completely agree. Lower middle market's where it's at if you're going to spend time in the space.
Yeah, I completely agree. I do think that's one of the primary drivers. Exactly. Those managers that will remain nameless that are hoovering in immense amounts of capital and have an immense amount of capital to put to work and need the flow and are perhaps sacrificing protection and covenants and to get the deals done. And it's become immensely competitive. And it's great for sponsors and it's great for the companies, but I don't think it's as compelling for investors. And I think that's really within the last few months because I think it was a lot more attractive in the first quarter.
Yeah, no, rush of flow into the space.
Vidak, I'd be interested in your thoughts in this area.
Yeah, I would just add who has done well in the last 2 years in the hedge fund sector is credit managers, right? Long and short credit managers. So, and the reason for that is simply interest rates. So we are living in a different interest rate environment. Before it was 0 to 2, now we are 4 to 5. So it's a big difference. And now the question is, how do you dissect the economics, the economy of this country? There's lots of abnormalities. Nothing is normal about seeing housing prices going through the roof, 30, 40, 35, 40% in the last 3-4 years. And then you look at mortgage applications at the lows. So fundamentally, you would think that the prices will not go up anymore, right? So it really makes the environment for hedge fund investing very difficult. There is the dispersion for long-short equity hedge fund managers because you can see where the leadership is. But then you have great companies, they are still 30, 40% down from the highs. So there's a lot of opportunities for good long-short equity managers to look for the alpha. Now, going back to for the question about private credit,
Yeah.
we are not really specialists for that. So
Okay.
I would pass it to someone else.
Fair enough. But do you have an anti-alpha category that you're avoiding?
Anti-alpha category. Well, we're looking at some categories that do not correlate with anything, but I would not call them anti-alpha.
Okay, by the anti-alpha, I mean areas you're just avoiding to invest in. Maybe good areas for other people to invest in, but you're just staying clear of them.
You have a question?
Can you address term of the term in relation to the transaction financing? Two covenants, what covenants are going in a competitive environment, covenants get lighter. Describe the covenants that you're focused on and what rates floating fixed for that term that you're lending on.
Well, I mean, to me, the issue is the covenants like in investor protections, like the inability of the sponsor to sell assets or, hive off assets or, I mean, the basic covenants are just going out the door. I don't know if you want to add on that.
Yeah, so your standard interest rate coverage, your leverage ratio, and I mean, so as you go up market, you have less negotiation as more bidders come in. So maybe in the lower middle market, you can, like it was mentioned, strategic initiatives, right? If you're going to replace someone significant on the e-board or you're going to do an acquisition would push your leverage up, you would have to reach out to the sponsor, get approval, and there's some check and balances with those observer seats. But yeah, and that's why the issue is in the upper middle market, like mega cap, it get coupled. Like, I mean, at that point, you're starting to compete with the traditional banks again. And they're not gonna. It's whoever is going to be willing to accept it.
Value percentage that you're willing to, go on 60-40, et cetera, 60-40. That type.
Yeah, I would say like if you're backing like maybe in the lower middle market because it's a little bit more let's say delicate in terms of those companies, you would want to see maybe 4 times leverage on the kind of debt they're lending to, and it's prudent. And as you go up in larger companies because they can claim to be more resilient, then you can see leverage ratios go up to 6-7 times, which is concerning, right? Because your other question about where are folks lending at, it's floating. For the most part, a lot of managers did floating, and it's argued to be an inflation hedge in this environment.
So that's a prime plus.
Okay,
SOFR plus spread.
I want to bring it back. I mean, we can go on that a little bit later. You can get them outside in the hall and get more granular if you'd like. And I want to jump into the topic that I'm sure you will only hear once or twice today, AI, right? So, Michael, I'm going to start with you, but I'm hoping Nick will join in. Where is AI now and where is it going?
Well, AI, so it's been around for 75 years since post-World War II. It's not new. There have been many booms and busts, or nuclear winters as the industry refers to them, where it's basically been overhyped and then it disappoints. Now for a confluence of factors, a confluence of 4 factors, we have record low processing and storage costs, record data growth. We have machine learning working, and we have data science. So you take those 4 factors and this confluence of them, and it's really allowed it to work. Like LLMs have become the flavor of the day, obviously. And AI is better than it's ever been because of those reasons. Now, that said, I think from an investment perspective, that's where the as you refer to as anti-alpha or anti-alpha, I think there's a lot of anti-alpha there, if you like to use that term. I think it's it's real. So it's a bit like the internet. And like I remember when I was a PM at Soros during the first tech bubble, right? The internet was real. It's revolutionized the world and society, and on it goes. And AI is analogous and similar. However, if you invested in a lot of those internet stocks in 99, you didn't fare too well, right? And some of them actually 25 years later, you did fine, but that was 25 years later. First, you ended up, down 40 to 99%. Some of them were zeros. from 2000 to 2003. So again, if you take a really long-term perspective, and again, obviously some of them today are, would have been immense home runs. But again, I mean, Marty and I have joked about this. I remember speaking at Marty's conferences like 10 years ago when a lot of these stocks like Microsoft was dead in the water. And I said, these are interesting value stocks. Like they've generated cash flow for years. They've just had multiple contraction, a bit like Walmart and Lowe's did for many years in the post also. And then obviously over the last 5-10 years, these stocks have been multi-baggers. So sorry, this is very circuitous and long-winded, but my point is, I would not be a buyer of many or most public quote AI plays today. I would not be a buyer of most AI VC today, because I think, to your point, that's where a lot of the anti-alpha is. In other words, it is real, it will be big, but the valuations and what they're pricing in is often way excessive. But over time, there's no debate. I mean, it is the future and Wall Street. Yeah, Marty.
That's what one comment. It seems to me like a lot of the LLM, large language model AI plays will actually cannibalize a lot of the revenue for the existing advertising plays. Like if you go to ChatGPT, you're not getting any of Google's ads anymore.
Yeah, I mean, it's a great point, Marty. It's a great point. I mean, there's that. I mean, yeah, again, it'll be very disruptive. Yeah, totally. It'll be very disruptive. That's right. And then the other thing is, well, if you want to talk about Alphabet or Google, the other element there is, if you look at TikTok and Instagram, those two are a different model, right? And that's where at least my daughters, who are 11 and 14, are. So there are existential questions for all of the tech companies, including the ones that are priced to perfection.
And I want to give one more example. So I have a robot lawnmower, and my wife has a super duper ironing board, and we went to ChatGPT to fix them when they had recent problems. Right, because ChatGPT has the manual and can walk you through every iteration and print out, point you to YouTube videos, etc., versus buying a new one. So it seems to me that Amazon may be hurt by it as well, because people will say you can be more resourceful and figure things out. I mean, I don't know.
Some people are lazier than you are, but
I'll just add that AI is here to stay. But as Michael pointed out, if you go back to the 90s, we had a lot of tech companies that by the 2000s are not around. So to me, right now, it's kind of a dual focus. You either should focus on the very large players because they've got the money and resources to take out the small ones, or take a lot of risk and be insane and go in the very early stage companies. In between, I don't think there's a whole lot of opportunities because of the way this is playing out. On the other side, at this moment, everyone loves AI, but few years down the road, we'll be hearing about the carbon footprint of AI. I was just reading something recently. A simple chat GPT query uses about 2.9 watt hours of energy, and a simple Google search uses 0.3, meaning chat GPT uses 10 times more energy than a Google search. So we can imagine what will happen to the energy and demand down the road. And I know the previous panel spoke about the energy. The U.S. has not had energy growth, demand energy growth in the last 10 years. Now, for the next 6 years or so, that's expected to be at about 2.5 CAGR or so. So AI is here to stay. It will simplify a lot of lives. There's opportunities to invest, but at the same time, a few years down the road, we'll also see a lot of pushback against it. And our view is that be crazy enough to look for some early stage companies that have very high probability of going under, but a high probability to be acquired by very large players, because 7 or 8 large players will probably dominate the market again.
I'm going to just toss in 2 quick comments on there. One is, part of the reason why the internet was constrained at the beginning was because there wasn't enough bandwidth. We were working off DSL and modems and things like that. It'll be interesting to see if there's a constraining factor to AI right now. And I think there probably is. It's probably data, and Michael's already grabbed the microphone, so I know he's got a comment, so that's good. The second thing I would say is the other thing that really drove the internet was the SaaS programs and the applications that came from it. And I think as AI gets applied to more and more different applications, it's going to revolutionize how we do business. And I think that's going to be the real dramatic impact in how we live.
Oops.
Just to bore everyone with the,
Somebody turned themselves on? Oh, I mean, no, I don't think it's Elizabeth, is it? Is she here?
You're a star.
I was just reading the other day that one of the fast food restaurants is using AI to take orders to eliminate the head count, but they're having a problem with it because AI cannot understand all the accents. So it's not working as well as intended. So
Yeah, well, that's, I have, anyway, yeah, I mean, you think about, right, like, look at the kiosks, for example. I had the misfortune of being at a McDonald's in Europe some months ago. I don't eat McDonald's. I'm vehemently opposed to it. But anyway, my daughters seem to like it, like most children. So anyway, and as I did when I was a child.
One French fry, right?
I did not. So anyway, that's not on my diet. But anyway, long story short, they had kiosks to order, and yeah, sure, you just put the concept in. If you look at GPT-4 and the next generation, you put and then take it one step further with robots. We're not there yet, but within the next 5-10 years, you add robots who are delivering and with the voice and with the ability to effectively listen and respond. You have automation and you have labor displacement, which has an interesting impact on society and what people do and how they make their money in that whole universal basic income concept.
Great. I want to just take
I
a
think most robots will be cannibalized. People will just knock them out and sell the metal. I think in San Francisco, when they started iron robot going up and down the streets, and the homeless people just took them and sold them for scrap.
Marty is absolutely correct. We invest in the company. What they do is they use robots to deliver food. And last mile or so, they have humans that have cameras through the robot and kind of maneuver the machine to bring it to the customer. But what they did not anticipate is the people in the street just knock the machine off and the food never gets delivered. So we've had serious problem with that simple anti-robot mentality.
Oh, that's funny. Vidak, I want to come down to you. Hedge funds is a $3.4 trillion industry. Last year, about 75 billion was taken out of that industry. The year before, it was 112 billion taken out of that industry. So will 2024 be the year we see more money go in than come out of hedge funds?
In 2024 or 2025? We almost did.
Tell me, you're.
I can basically also say hedge funds are here to stay because they're not supposed to, they have a reason they have a reason to be in the portfolios of large institutions. Why? Because it's all beta, right? So what if we have something happens in the next 3-4 months geopolitically, and nobody talks about it because everybody's watching CNN and Fox, and they don't have time to go on YouTube and watch other channels that are available. We are in a democratic society. You could go on YouTube and you can watch what other people say as well, if you have interest. And what other people say or what other channels are saying is very, very different than what we're hearing in mainstream media. So what if we have, right now we have all beta, right? Everybody's long and strong. But we might have also some geopolitical issue which could translate into potential some nuclear warfare. What happens then? So the reason really the United States, the US stock market has been amazingly strong and is gathering all this money from everybody is because of safety. We're far away from Europe. Lots of people escape Europe. I mean, I guess most of people in this country, the ancestors, they came from Europe. And why? Because there's a lot of things going on there. Look at the soccer. There is a European soccer right now, and lots of national teams are getting penalties because they're saying things that are not right in the sport arena. So there's a lot of nationalistic flames.
Sure.
And again, we are far away. Who cares? It seems like things are okay. But underneath, things are not okay. So that's why I think you do need to have hedge funds.
I don't think
Hedge funds are going to
even
gather
the
off.
nuclear war matters. I mean, you could just have Venezuela invade Guyana, and that would cause all kinds of problems.
Well, in the past, in the 90s, for example, if something happens I'm sure you were following that as well at the time. If something happens in Brazil, something happens in Argentina in the 90s, stock market goes down 10%.
Right.
Now, Russians are coming close to Cuba.
Right.
Nobody cares. We rally.
Everything's around.
So I don't know. I think hedge funds are here to stay too, as well as AI.
Well, wait, I'll chime in on that as a prior, I've been very involved in AMA over the years, the Alternative Investment Management Association, on the board a few times, and I'm on their investor board now. And, you know, so had one of the two largest hedge fund industry trade groups effectively. And my sense, for what that's worth, is, and I'm not representing them in this panel, but these are my personal views. But my sense is, look, yeah, hedge funds are, I mean, it's a multi-trillion-dollar industry. They're here, they're not going away, but I think they're mature and the growth is past. I don't think, like you mentioned, outflows the last few years, but maybe 100, you know, X 100 billion flow in or out per year, but the growth is behind it. The growth in alts is, or will be, in private wealth, multifamily, family offices. And then within that, it will not be hedge funds because of the, in my view, because of the complexity and the tax inefficiency. It'll be private equity, private credit, secondaries, maybe venture. That's my view.
Great, great.
I'll just add very quickly in terms of hedge funds. What we need to keep in mind is, while hedge funds do phenomenally well when there's a decline in the market. So when markets go up, hedge funds are not popular. But two of the issues, in my view, the hedge funds have, first is succession planning. Most of them cannot have a proper, phenomenal succession planning. So some of the great ones that we see now, we're probably not going to see down the road. And the second part is the fees. We have beta doing quite well, and fees the hedge funds charge, there's some pushback there. So I did read some stats. The number of hedge funds that closed down this year is pretty high. So they'll probably continue.
I agree. I think, lack of volatility over the last few years has certainly caused the issue for hedge funds. And now that there seems to be some volatility, as Vidak was pointing out, that seems to be feeding that there's some future for them. Although, they
VIX is what, 13 now? It's very hard to make money in the hedge fund world. I feel sorry for those guys. Not only do they have to market their funds and maintain the assets, but they have to be, dealing with things that are just not normal these days.
Well, but how about the fact that most managers don't have a hurdle, right? Whereas private equity does, right? And so you have cash SOFR at 5, right? 5.25, and there's no hurdle. And so, right, you get paid 5.25 and you're collecting 20 on that, right? 20% or maybe less. But
yeah, I think 220 is dead, right? For a long time, for 10 years or so. Now I think the average management fee is down to 1%, maybe not even that, and the performance is maybe 15%.
Yeah, so you're still getting
It's not
15 on
220 anymore.
you're getting 15% on 5.25 cash, no hurdle, right?
They do, but I think also it's not. I think the startup hedge funds, they should not be getting any management fee, because whoever is starting a company is not getting anything anywhere, right? Those established ones that have proved themselves, they should be earning 1% management fee, in my opinion.
I want to move on
Be
to
more
some other
incentives.
areas here because we've got some more ground to cover. Balaj, what are your thoughts on venture capital right now?
So we were mentioning AI, and so if you backed a good venture capitalist, they would have already invested the seeds 10 years ago and have manifested returns for you. So, I think in venture capital land in AI, just trying to tie the threads, developer tools and vertical data moats is a theme that made a lot of investors money in the last 2 years as ChatGPT got mainstream ground. Amazon acquired Hugging Face, for example. It's a building out their corporate facilities to facilitate AI going forward, for example. Now within venture capital, what's the next theme that we're trying to, and so I think space is a concept that venture capitalists are trying to understand and develop ideas around and incubate. Food tech is an important piece too, as we think about sustainability going forward. And then quantum computing at the end of the day to be able to power the future for us. So that's venture capital.
Yeah, I agree with Balaj on those. Those are all interesting. Food tech space, quantum, totally. But I think to your sort of what you were saying, maybe they should have done the AI X years ago, right, and be harvesting that now. But now is not the time to be, in my view, buying pre-seed, seed, A, B, VC, or
You have to be really targeted
sorry.
within, within AI's team, because, kind of like an argument a venture capitalist was sharing with me was, the way that Google won kind of the search business many, many years ago by just focusing on search, in the way that ChatGPT is kind of like mainstreamed its use case for a lot of people. Like, not a lot of people use Yahoo or Bing, right? We all kind of gravitated towards Google. So it's like kind of gravitated towards ChatGPT. Do you need other interfaces? But I guess we'll see, right? Because it's all about acquiring the right data that makes it useful for people to, as they prompt engineering becomes a real job in the future. So those will be the winners. But I so mentioned in the seed round, right? So valuations in venture capital land is interesting. The late stage folks have been heavily impacted over the last 2 years as a lot of players left the space. Some hedge funds, notably, that crossed over into private market land, got burned at the end because it was a good trade when rates were zero. You come in at Series F, Series G, and IPO, and there's a 3x, and IRRs look really great, multiples too. And so those are more realistic. I think private markets have been a benefactor of like, I guess, flows from hedge funds. But I think if you're a private market investor, one thing that's on top of everyone's mind is, what are those marks and are they really real? And thinking about that as you make your commitments in the years to come is really top of mind for us, at least. Yeah, Marty, please.
I had a VC come to me and said that they had 5x MOIC. And I said, where do those like an exit? Like, did you do IPO or did you get acquired? I said, no, it's like next round.
Yeah. And they're not raising, right? So you got rounds that are marked at 2021 and they've got bridge financing in between to kind of shield them from like what the true equity price of that stock is. You can also use the Black-Scholes, and there's different ways to price it to keep your marks where they should be in your mind. But that's like but in seed land though, it hasn't moved, right? Because there isn't a real mark to compare it against versus the late stage folks. So,
but I also think it's important to add in the VC space, with the collapse of Signature Bank and Silicon Valley Bank, the landscape has changed completely. Because prior to that, if you had a valid idea and coming of age kind of thing was getting an account or being financed by Silicon Valley Bank, and they'll always provide the line of credit. So it really didn't matter if you needed a month or 6 months or 2 years to go public. So the IPO market is not there, and there's no source of funding for these companies. So all of a sudden, the VCs are faced with a much longer time horizon in terms of taking those companies public or selling, doing anything with them because the banks are not there. And in terms of the investment ideas, what Balaj mentioned makes sense. And I'll just add the prop tech as well, because with immigration, the population size increasing and people living longer, so prop tech also is an interesting area to look into.
Sure. And I'm wondering, and I'm going to jump into secondaries off that venture capital discussions, because we're seeing them now, a lot of continuation funds, or we're seeing secondary funds with the intent of buying up shares from private investors to invest there. And a lot more money has gone in that area. So Michael, you want to?
Yeah, so secondaries I do think are interesting because, again, without spending an inordinate amount of time, you have the denominator effect. Institutions have been overweight. Private equity, they still continue to be. They're effectively for sellers because the boards or CIOs or they're outside of their strategic allocations, or and then to Nick's point, you have a dead, largely what's been a dead IPO market for some time now. So there have been no exits, and then consequently, like last year, you had distributions from private equity firms at about 12% versus a 25-year average of 25%. So about half of the 25-year average. So all these investors, particularly institutional, but also families, I know families who, the same thing, they budgeted in, they modeled in, oh, well, I'll have these, 25% per year average distributions, and it's coming at half. And then they had planned on using those distributions to meet capital calls for the other funds, and they don't have them, so they can't. So therefore, they're forced sellers. So, when you have a supply-demand imbalance like that, I think it's interesting in the secondary market. So I do think, and secondaries, they were trading at around 80 cents on the dollar on average. It's ticked up a bit, I think, to about 84, 85. And then VC was trading at about 67. I'm not sure where that is at the moment. But, and again, these are averages. They're meaningless, meaning high-quality funds are much tighter, low quality are much lower, or wider spreads. But sorry, it was a very long-winded way of saying, I do think secondaries are interesting. Continuation funds are another thing, but I'll pause.
All right, I was just gonna toss it down to Balaj to comment on yours, so.
Yeah, I agree where valuations are, especially with the high quality. And again, it goes back to that NAV, right? When things are good, GPs are good to reflect it, and when things are bad, stays flat. So being cautious about where valuation is, I don't think the margin of safety is what it was maybe 2 years ago when you're participating in the secondary market, but it is outside of private credit. It is the next area of boom of asset growth in private market land, which will make the prices go up, right? And so now you're buying things at par premium when, the logic back then was, okay, maybe you get this discount and then you get flows come in and NAV picks up. But I'll talk a little bit about continuation vehicles because that's been a way for GPs to manufacture DPI, which is very sacred right now in this environment. It's interesting. So I was talking to a secondary player who was trying to bid this asset in the CV market. So this GP goes to the market, goes to the banker and says, I want to sell this company for 10 times EBITDA. The banker is only able to get that GP 8 times EBITDA. So then the GP decides to go to the continuation vehicle market, and secondary players in the continuation vehicle market are willing to pay 10 times EBITDA. So just to talk about like the evolution of the space where, back in the day, GFC, we've extended the hold period. We need to get rid of these zombie assets to raise the next fund. Now it's evolved to the crown jewel market where a lot of these GPs have been holding this asset for maybe 2-3 years. Value creation plans going well above plan. They want to own it. And so, they can find the CV market as a quick exit, get the DPI, momentum, the fundraise, and close the new fund.
Let's move on to real estate. Where in real estate?
So is it really that easy though?
Well, if you did a good job with your portfolio, right? If you have something that the market wants to buy, and a lot of what GPs are doing now, these multi-asset continuation vehicle funds, where they'll package it with maybe an asset that's not doing so great, but secondary players will be willing to bid it because of the crown jewel that's embedded.
Wait, I think to Marty's point, Balaj, it's not that easy in that because the statistics, as far as I understand, are 80% of existing LPs don't re-up in CVs. Whereas, so if that means you have to go outright and raise that 80% of capital to replace the 80% of LPs that are existing that aren't. So that's I think challenging, right?
Yeah, 100%. Yeah, and only LPs will not take the status quo if the value of those assets means something to them, right? I think for them, they look at it as like a seasoned co-investment fund where they can roll into an asset with no blind pool risk and have this value creation plan lever like clear as day because the GP knows the asset and the management team. But yeah, to your point, it varies, right? Between GP to GP, portfolio to portfolio.
I think LP scrutiny is far greater than ever before.
Yes.
And they have far more ability to drill down and ask you very detailed questions that you might not have been asked 8 years ago or 10 years ago about continuation.
Yeah, but just to take the other side of that, Marty, to take the other side, Mark, is you have this, so the 80% of LPs are not rolling in, right? But the GPs inherently are because otherwise no one will invest.
100%.
So how is that not inherently conflicted? Because you have basically, again, you have like institutions who are, for whatever reason, investment committees or investors who are tired and or who want the liquidity. And so they're selling, and then you have the GPs still owning, and you have new investors coming in. So I think that raises interesting questions.
Yeah, so the best practices that have evolved in the space are getting the LPAC approval from the existing LPs in the fund, making sure it's an arm's length transaction by getting an independent auditor to value the asset. But then again, it's still going to be imperfect.
What do you guys think about since we're talking about an alternative, what do you guys think about search funds in these market conditions?
Search funds.
Search funds.
We haven't historically invested in that space. We are aware of it in terms of what the opportunity set is, but that hasn't been an area of focus for us.
What is search funds?
Search funds is when you back sort of like a SPAC, but on a
It's a private SPAC, yeah.
private SPAC, if you would.
It's really not a private SPAC at all. It's being.
Well, it's not
You're backing an entrepreneur to find an opportunity.
Oh, yeah.
Sorry. You're back.
There's another term for that. I just can't think of it.
Yeah, so you're backing an entrepreneur to go and find a company that you're going to invest in. I mean, there's a lot of that stuff happening right now?
Yeah, I've looked at some of, yeah, I haven't done anything in that, but I'm familiar with this space. I have a colleague I know a number of people who are involved in those, right?
Because I think I'm sorry, why it's interesting is because of the baby boomers getting to an age, they have to get out pretty much. And so the valuations, we're talking about alternatives, so the valuations can be interesting if they can't find an exit.
And there's actually a guy who's in the fund of funds in the search fund space, and he's like 35% return. But I mean, it's like a search fund association of America. You have to go to all their conferences and meet everybody and figure out who the winners are.
How big is this space?
It's not big, but the growth can be astronomical. You know, so this guy made his money by buying, you know, a couple of $2 million companies, combining them and spending $400 million to a company in Asia. And then they made him the president of their operations in the United States, right? So I mean, there's a lot of great opportunities, but you have to, you know, it's like usually Stanford MBAs, Harvard MBAs are you know, come out, they're trying to find.
Yeah, we have looked at that, and we typically prefer someone who has done something comparable in the future, in the past. It's not their first rodeo. So giving someone money and to charge us to go find an investment is probably not something that we're too thrilled about. We may miss some opportunities in the upside, but rather do it the second or third time around as opposed to the first time around, just simply because of the amount of risk involved. Plus, I would argue that on the East Coast, the idea of venture capital or early stage investing is not as advanced as it is on the West Coast. I was a general partner of a venture capital fund focused on space. And every time we had an opportunity to invest in SpaceX, literally would take the guys on the West Coast a couple hours to fill it. It would take me weeks and weeks to talk to people on the East Coast. And why is Elon doing this? Why is he doing that? And answering all the questions. By that time, I would get through the first person, the guys on the West Coast, like, okay, we're done. We got the capacity completed.
Sorry. I just want to add, it's the other acronym for it, or name is ETA, Entrepreneurship Through Acquisition.
Okay.
It's also referred to as that space. And there's a program at Harvard, and then I was with some colleagues at Columbia a few weeks ago. Anyway.
No, it's definitely growing in popularity, that investment strategy. So thank you for raising it. I want to move on to real estate and where you're finding alpha right now on real estate and where you're not finding it.
So some themes I'll just quickly touch on that we found interesting. Storage is a play that we've spent some time in. And, you know, retail is obviously underperformed in this market cycle. And so being thoughtful about your pockets in that space. So, you know, anchor grocery stores and having that exposure, maybe more recession resilient than, you know, the traditional mall or luxury apartment, are two kind of themes that we've been working on this year.
So Meketa, Joe, you first.
So we're crazy enough to be in real estate in New York and be in residential. Anyone that has exposure to residential in New York knows how crazy the laws are, how everything favors a tenant and everything's against the landlord. But I've been very selective, and we're north of New York City. Our view is that with the immigration, the numbers coming, and these people need to live somewhere, so the demand is there. New construction is not there. And as long as you kind of navigate the pockets, stay away from certain troubled areas, so to speak, and understand the regulation, you can do quite well. But you have to be very selective, and you have to really roll up your sleeves to find opportunities.
Yeah. So distressed, I think. I mean, I think I may have mentioned this at one of Marty's prior conferences within the last year. It's been a little slower to come than I'd expected, but I think it's coming, and it can't not come. So distressed real estate, obviously, particularly commercial, office, but also beyond that. From a high level, you know, you have the regional banks they had the duration crisis. The credit crisis, in my view, is the next shoe to drop. They have massive commercial, real estate loan portfolios. And it's simple. SOFR's gone from effectively 0 to 5, and cap rates are up. So properties are worth less. And then you layer on top of that lower loan to values, and then possibly diminish cash flows because insurance costs are up, inflation is strong, labor costs are up, and on it goes. You layer all that together, and you have diminished or wiped out equity, often wiped out equity. And so that is a very favorable backdrop for beyond stressed and distressed real estate. And whereas in private credit, so contrasting it with private credit, whereas that sort of become all lend, extend, and pretend. And I had thought prior to January that you'd have a nice private credit stress cycle. Since January, my view has been not at all. And as I mentioned, in fact, I think there's no distress cycle happening in private credit anytime soon. But real estate, I think it's unavoidable and it's imminent.
Vidak, did you want to add in anything there?
I think no one talked about multifamily, but multifamily, it's all regional, right? So in some parts of the country, they're doing well. Some of the parts of the country, they're doing awful.
Delineate the areas you think are doing well and the ones that you are.
Red state and blue state, maybe? I don't know. We're close to election, so I think that in terms of multifamily, you also have to look at the rents, right? So the reason that inflation has gone down is because rents have gone down, right? But nobody's building anything. So what happens with the rents? They will go up again. So we'll have inflation again. So it's an issue. As long as we stay in the 4 to 5% range, go ahead, please.
So we're going through a paradigm shift. I mean, our economic speaker who spoke recently said he doesn't see rates going below 3% anytime in the near future.
Yeah.
Right? So as much as you may have distressed real estate, it still has to work out that you can get the leverage somehow because you're buying this distressed real estate now with 50% leverage rather than 75% leverage. Right? So I mean, so I think the level of distress has to become greater to make it work out, to make it more economically feasible.
Yeah, we're not there yet at all.
That's what I'm saying, but you're right, because you have to find the financing to make it work.
But for example,
In New York City, that just passed a couple days ago, the annual rent increase 2.75. Inflation is a lot higher. So if you own multifamily in New York City for 1-year leases, you can only increase by 2.75%. Your insurance rates are probably going up anywhere from 10 to like 80%. Taxes are going up, operating expenses are going up. So try to figure out exactly what we
how do you make that work?
You don't touch New York City. We're outside New York City, though. We're in Westchester.
Oh, I see.
It is, I mean, there's an insurance crisis in Florida, for example, of condominiums right now, right? For anything older than 30 years, they have to totally, de-risk your place you live.
By the way, the condominium crisis is not just in Florida, it's throughout the country. So now every condominium, as a result of what happened in Florida a couple of years ago, they have to assess their finances, which was never done in the past. I spoke to a gentleman, he has a company out in New Jersey. He used to do about 30 or so assessments per year. And I think first 3 months of this year, he did over 500 or so. So every co-op in the country, I believe it's a federal mandate, not a state level one. They have to assess finances. And the second part is they have to assess the mechanical aspect of each building or so. So co-ops will see substantial costs down the road.
Yeah, I was going to say the same thing. It's beyond Florida, it's national. And then with uninsurability because of California wildfires, et cetera, that's another whole dynamic in term.
Yeah.
So we know that there's distress, but the question is when you jump in.
Well, I think it's going to start like imminently, and I think selective. Again, I think it's an alpha trade, not a beta trade. I think you don't like just buying like this buildings, let's say in this area or east of this. Like I would not buy commercial, I wouldn't buy office buildings east of this building in this area because I don't think many people want to go from Grand Central or Penn Station east of this building. But again, so I think it's very much an alpha play. What is the building? Where is it? Is it ABC? Is it near a commuting hub? If it's office, for example, and then but and then in terms of conversions, much of that, as I'm sure Nick knows, is uneconomical unless there are tax incentives and or changes in zoning.
Yeah.
And just a live example, changes in zoning. For example, if you wanted to repurpose this building, you cannot put as many apartments because each room has to have a window. You can put apartments around, but what do you do with the space in the middle and every floor? So whoever figures that one out will probably do quite well in real estate.
Well, again, to your point, or to both of our point, that's why I think you need changes in zoning. In other words, they have to change that rule that every bedroom in New York City has to have a window. Otherwise, these buildings with these immense floor plates don't work. And you have and then the other thing is people don't necessarily want, immense floor plates where it's like dark in there and you're far from a window. And so, yeah.
So I have a perspective. I'm in the multifamily space, so I'm gonna kind of aggregate everything that was said here into the trade, right? So sell blue state assets, especially multifamily, right? So selling blue state assets, buying red state assets. Interest rates are higher longer, they got higher quicker, so there's distress, right? But at some point they're coming down. It's not going to be 3, but 100 basis point swing in a leveraged asset like real estate, it really juices your return, right? So even if they come, just recently, the last couple of weeks, that the movement in treasuries could have a humongous swing, and if you lock in your debt, right, with Fannie or Freddie. So that my view and our view as a company is the trade is imminent. To your point, get in before the rents start to go up, before the election happens, and there's a signal that rates are going to be cut, and all of a sudden the institutional money flows in and starts to drive prices up. So our view is the next 6 months is really time, because if you're forced to sell right now, there's a reason and there's distress, right? It's a bad time to be a seller. And if you can hold on to your assets right now, you're trying to hold on. So that's our view.
Yeah, I think that's sensible.
All right, one area we haven't touched yet. We're gonna have a lot of fun with this.
Before you move on, is there an opportunity for family offices in the credit space of real estate? Like in debt? Hard money seems to really come back in a big way. So maybe.
I think there is in the real estate space, absolutely, but for the reasons that you were just alluding to. In other words, if you have rescue finance, yeah, I think and I think absolutely.
I think we're seeing like 12-15% rates coming out on hard money.
I agree with that. And the gentleman mentioned the election. I think that's key as well, because depending on how the election goes and what happened with the tax and rates. Going into this year, we expected to have 6 rate drops, and we haven't had a single one. Now we're talking about possibly 1 rate drop this year. We all know rates go up pretty quick, but they come down pretty hard. So if real estate investors going to a bank and getting a loan right now, it's like getting a colonoscopy. So you better off finding alternative sources. And yeah, family offices that have a time horizon, number of years, it can turn things around pretty quickly. Yeah, there's an opportunity there.
Well, and I just want to add to the gentleman in the panel, in the audience's point. Right now, no one. I have friends who are running distressed real estate funds, and I think they're very good investors. They can't raise money. No one's got money to invest. No one's investing. It's sort of the same thing as private equity and VC. Families and/or institutions are overextended and they're not investing. So when it's exactly the time to invest, people aren't investing, which in turn makes it a good time to invest, I would argue.
That's the paradigm shift, because of the rates, and as you said, people had expectations of getting capital back, which they didn't get. So,
all right, we're going to move on to one more area here, and Marco, this is going to be particularly interesting for you because it's crypto, blockchain, and Web3. We haven't really touched on any of that here. Marco has got a family office that does a lot in this space. Do you want to talk for a minute on it?
Sure, thank you.
you want to give them
Just go by surprise.
We
you're good in your field.
invested in the blockchain system, obviously what is considered today Web3, precisely in applications to trading within our own platforms, to metaverse, where we're digitizing and virtualizing all of our businesses. This is some of the examples that I can explain.
No, and I think that's really interesting because I think the generation that's coming up now, the ones that are attached to that thing on the end of their arm, it's a cell phone, right? That generation, that's how they all communicate, how they socialize is through the internet. I find it strange because, when I was young, Friday nights and Saturday nights were sacrosanct. I had to be out. This generation, that's not necessarily the norm. So the way they're going to do business, the way they're going to socialize is going to change how we do business, right? So I think it's very interesting opportunity that's coming. And I certainly think AI is going to play into some of that as well. But as an institutional investor, What do you think? How do your thoughts go in this area?
Yeah, so kind of similar to AI, if your venture capitalist was doing said job, then 10 years ago when the white paper came out, then they looked into the space. And so we've had exposure, like let's say if they have the ability to invest in quote unquote fintech, digital assets might be a part of that subsector. And so we've had a few winners in that space, but we've had a few losers along the way. Notably, I think FTX was a common name that a lot of FOMO VCs had in their book, and the way they kind of justify it is, well, it was only 50 basis points, guys. Like we were just making a targeted bet, and it didn't work out. And so, we've had token exposure that worked out. They've liquidated it, so it's like real realized gains in some of our VC books. These days, when you talk to managers, I think in the last 2.5 years, AI has really just been the focus, and we haven't really spent time in a dedicated crypto. We talked like to those names, but it's just you have to really have as an institutional investor being comfortable by making that really targeted bet.
Yeah,
I think the issue with crypto is custody. People just don't believe it. It's not there. I mean, valuation wise, also, it's tough because there is no cash flow. This cannot be valued as an asset, as other asset classes. On the other hand, there are a lot of promises and a lot of, it's like a revolution. It's very intellectual and and also there is, for example, if you want to know where Goldman Sachs should be trading at, you can talk to sell side or buy side people to value Goldman Sachs. But Bitcoin is all among, as you said, on the phone, digitally. There is no one really valuing. It's very democratic in that way. It's here to stay as well, I think.
I think you need to take and so I agree with part of what Vidak said, which is for Bitcoin, there's no present value of a future stream of cash flows. So what is it worth? Whatever anyone wants to pay for it, 100,000, $1 million, more, or zero, or whatever. But then you have others like Solana and ETH or Ethereum, which are potentially actually quite valuable because you can use them to and they have value for smart contracts, which I think are not going away, are very sensible and have a future. So, but again, I mean, how much are they worth? And that's a different debate. And again, that will be a competitive market. They don't have a monopoly on it, and there's no reason they will, in my view. So again, I think it's a very much an alpha security selection market.
We don't have any expertise in crypto, but we do have exposure to it. We allocate it to a fund very similar to a hedge fund. And that's the only time when I count my blessings that I do not have any outside investors, because there's months when we're up 30, 40%, but there's months we're down 50%.
And no one can explain why.
No one can explain and don't understand what it is, so wait for the next statement.
I think, we talk about leading indicators, and I think crypto is very much acted that way, right? That when money gets tight, people withdraw their crypto and liquidate that and put it to work and other assets and things along that line. And when markets start getting good, crypto is the first to go up because it's easy to put your money in and you have the liquidity right away if you want it. So I think it's a very much a leading indicator and more where the economy's going. So it's sitting at 62 or whatever right now, Bitcoin, right? And Ether is still above 3,000. So right now it seems to be fairly stable. So maybe that's a good sign. Marty, what's our timing?
About 2 minutes. Do you want to take some questions?
Sure. Any area, any topic you want to cover? Because we just did the whole 2 days in about an hour. There you go, Marty.
Really quick, lightning round. How are you hedging for the election in November? If
We don't. I mean, again, when you work for yourself, you kind of have a longer time horizon. You don't have to account to anyone. And look at the tax aspect of things. I think that's going to be the first impact of the election. And the second part will be the rates. My personal view is that we're probably not going to see a lot of rate cuts from now to the election because we don't want, the Fed probably doesn't want the criticism impact of the election, but we expect the rate cuts to hopefully happen after the election. So kind of position the portfolio for those rate cuts after the election, regardless of who wins.
Yeah, sort of similar to Nick. Well, sorry, let me clarify. The first part, I don't know who's going to win nor but not more in investing top down, bottom up, thematically and otherwise, but not I was a PM at Soros. We were discretionary macro fund, but not doing that anymore. And I think but that said, I think to your point, I do think companies like that we invest in should have thoughts because it can have serious ramifications on their businesses as to who wins. So I do think there's that dynamic. So I would just want to make sure that the companies I'm invested in have thoughtfully thought out, like, are there major repercussions?
Well-diversified, non-correlated managers across the spectrum. I think a little bit of gold. I think that's also a prudent way to go about it.
Yeah, I have a boring institutional talking point, diversification to insulate volatility at the end of the day.
Steve?
Would be any logical reason for rate cuts at all, given the fact that the first speaker told us that inflation ain't going down. If anything, it could potentially go up.
I would say weakening consumer all of a sudden.
But then you're talking about a decline in the economy.
Yeah. We're talking about
The basis of that.
the basis is that consumers are maybe overstretched. That we don't notice. You have to look at alternative data and see what's happening at McDonald's, what they're saying. I think that the lower end consumers are overstretched in this country because of inflation.
I could actually, I could actually make quite a bullish argument now in that M&A volume year to date annualized is just shy of the pre-pandemic peak. And so M&A volume is coming back in a material way. And if M&A volume is coming back, then that means private equity firms can sell. And then if private equity firms can sell, that whole flywheel gets going again. And then if there are distributions, investors are happy again, then they can invest again. And then if there's M&A, companies are worth more, markets valuations should be higher, not lower. So I could make this again, I used to work for George Soros. I mentioned it 2 or 3 times, reflexive argument that you have this whole new virtuous circle coming. And that might actually be why equity markets are at or near their highs. So you take that, and I think it's quite bullish or constructive for equities. And I look at my private credit view, not as constructive. So I actually think now one might want to be more weighted towards equities than credit.
I'll add, it was mentioned earlier that the credit area will probably see declines in real estate. And I would argue that both parties want lower rates, regardless of who wins the election. Both sides will push for the lower rates as well. Now, if you have defaults happening massively on multifamily real estate side, there could be another reason why to drop the rates. Plus, international banks have already started reducing the rates and not had major reasons to do so. I think some of them may add in sync.
So Nick, Michael, Vidak, Balaj, great job. Everybody give him a hand.